Good afternoon, everyone. Hope you are reading me loud and clear. The markets are certainly reading good news into everything that they're looking at today. We got new home sales, which were up 16.6%. That's quite a jump from last month. So that bodes well for market participants. Everybody seems to like that. The really big news was Navarro walking back a very negative reply to a question he was asked by Fox Business News yesterday, whether or not the phase one deal was a problem and whether or not it was going to continue, or what chance there was of it continuing. And the question really was about the relationship between U.S. and China. He gave it a resounding no. In other words, the deal is not going forward. That was the interpretation. Dow futures immediately took that to heart and sold off. They were down 400. Then that was walked back by Mr. Navarro. President tweeted on top of that. And so far, the markets believe that walk back because at the end of the day, in my opinion, the president didn't want to see the stock market come undone. We know if it comes undone, his reelection chances get muddied at best. At worst, he won't have much of a chance if the stock market plunges heading into the election. So when he saw the futures, in my opinion, he had Navarro walk back his negativity. And Navarro's statement was basically that he was grossly, I think, misunderstood or taken out of context. So really, if you watch what the interview was about, if you listened to what he said, if you watched his expression, he walked back something that he actually meant because he was probably forced to do that by the president. So nonetheless, markets liked it. Markets are up, and you just continue on and up and on and up. Why? Well, because there's nowhere else to go as far as returns. We've got the appreciation potential in the market. And then if you're looking for dividends, you're looking for yield, just plenty of great dividend yielding companies in the entire market. There's probably 30 really great, safe dividend yielding stocks out there that have the equivalent appreciation potential, not of all the stalwart growth stocks and not of the big mega cap stocks, but certainly at a rate that maybe would be somewhere between 5 and 7% a year, on top of what you're probably likely to see in terms of dividends, anywhere from 3.5 to 5.5%. And in some cases, Wells Fargo was one I like. That you got a dividend yield there of over 7%. If you're a long-term investor and you're looking for yield, something like Wells Fargo and some of these companies that are 3, 4, 5% dividend yielding are great plays to hold on to. Some of them have tremendous upside potential. I'm just talking about conservatively. If you see them grow, 5, 7%, that's very, very conservative. Most of them will probably grow along with the historical trend of the market, which has been above 10% a year. So you've got all that going on for you. There's plenty of investments out there. A lot of folks are now chasing the cyclicals, are chasing the industrials, they're chasing the beaten up stocks. Once again, the cruise lines, once again, they're going after some of the beaten up sectors we talk about here all the time, the airlines and the banks even. And the banks, again, I like Wells Fargo. That's a long-term hold in my opinion. But if we look at the banks, and we're going to, they're not out of the woods. They're not screaming higher as I think they should be if we are certainly on the other side of what this recession is we're only heading into. It looks like on the other side, but the market is acting as if we are already discounting full knowledge of what the depth of the recession is going to look like, how it's going to impact the economy, how it's going to impact bankruptcies, individual businesses, employment, unemployment, all of those metrics. The market's looking at it saying, we know bad news is coming and that it will come and go quickly. We'll see if the market's right. So far, it's looking pretty good. I don't know that it speaks for the economy as well as the economy can speak for itself. That remains to be seen, and we're going to see that coming into the third quarter. We're going to get, starting in 2 weeks, we're going to get the earnings reports from the second quarter. They are going to be very interesting, to say the least, and telling. So we'll talk about those in a minute or two, but I want to go over some of the things that are moving the market this morning. And we'll also talk about some of the things, and in particular, one thing I'm looking at that I think can move the market negatively. So right now, the bulk of what's out there is moving the market positively, and that's all good. The trend is your friend. You want to stay with the trend. Trying to catch a falling knife by shorting certain stocks here, it's a tough game. It doesn't mean that you can't hit it out of the park if your timing is right, but trying to time shall we say, a bout of profit taking, a sell-off here, that's very tough to do because for the most part, and I've been talking about this regularly in my live streams, up until Thursday of the week before last, when the market sold up, when the Dow was down almost 7%, that Thursday, I believe it was the 11th, the volume was very high there. And that was a very down, very negative day. And the volume was a lot higher than the averages had been. Every other day, every other time, the market has gone up on good volume, and every time the market has gone down, volume has simply diminished, and sometimes drastically. And again, we talk about conviction here all the time. So the conviction there is that investors believe the market wants to go higher, and they want to be on the right side of that. So when the market starts to go up, they pile in. And if the market's starting to go down, they don't jump on it. They don't sell. So we don't see more volume. We see less volume. So there's less conviction that the market is, if it goes down, can continue or would continue to go down. So that's been a positive up until Thursday the 11th and last Friday. Last Friday, when the Dow was up by 357 points, ended up down 208, we saw the highest volume we've seen in a while, even more than we saw on Thursday of June 11. So that, I think, is a little bit of a warning sign that maybe sentiment is changing. It's getting a little more nervous, I think. The investors are a little more unnerved. Why? Because the rallies perhaps come so far, so fast. We saw that nervousness play out again in the futures. The futures were down 400 points this morning. Okay, so coming out of the commentary from Peter Navarro. So that's a very swift reaction, very negative reaction to something that really I don't think should have had that kind of reaction. Nonetheless, that's a sign that investors are betting, and sometimes those are institutional investors that are betting with their futures, that they can maybe push the market down and push some nervous investors into selling when the market opens up. Other investors took that as an opportunity to buy those futures on the dip, turned it around, and we opened higher, and we're certainly higher on the day. This is an FYI as far as how high we are and how far we've come. We're only, to get some stats for you, we're at where we are now, we're about 11% on the Dow from its all-time high. So mathematically, that's about 12.5% to go from where we are now. The S&P, we are 7.5% approximately from the highs in the S&P. And that mechanically, to actually go from here to there, was only a move of 8.12%. These are not big moves. So we can very easily get to new highs for both the Dow and the S&P. And I have been calling for that for a few weeks now, but perhaps just a little over a month, that we will see new highs on all the majors before the end of the year. And we're knocking on that right now. So obviously, the NASDAQ composite, we know, just hitting it out of the park, making new highs. Again, another new high today. I can't imagine we're going to end the day down given the momentum we've had this morning. So that means that registers another new all-time high for the NASDAQ composite. So I'm going to take a couple of quick questions, and I'm going to talk a little bit about why these new highs are important and what's driving them, and briefly talk about one of the things that may knock the market down. One of the things that the market has to worry about, that we have to worry about, and it's not a blind side. It's not something that's going to come out of left field. It's something we're watching, that we talk about, and we'll be able to watch happen. And it has to do with volume. It has to do with retail. So I'll come back to that in a minute. But let's get to a couple of quick questions. John, all good. All good? Good. I'm glad. Glenn, Shah, good afternoon. Good afternoon to you, Glenn. Thank you for sharing with us today. My absolute pleasure, Glenn. Peter, yes, WFC 20-day crossed to above the 50-day a week ago, and stock is drifting lower. Shouldn't it have been heading up? It should have. But what happened is the financials have gotten a little bit weaker. I like Wells Fargo. Peter, I think you know that. To me, the reason I like Wells Fargo, and I'm going to pull it up when we take a look at some charts. So if you folks have any stocks you want us all to look at, I'll be happy to address them, pull them up on the charts, and I can go over them graphically with you. I'm going to take a look at some of these. And Wells Fargo is one of them we're going to take a look at, Peter. But a lot of folks ask me all the time about Boeing and Disney. Those are two stocks I get asked about, perhaps more than any others. I get asked a lot about the airlines. I get asked a lot about cruise lines. I get asked a lot about the financials. And for whatever the reasons, I think I know investors really want to know about Boeing and Disney. And we'll look at those, and I'll tell you why I think a lot of investors are interested, and for the right reasons. So yeah, Peter, we'll take a look at Wells Fargo graphically, and we'll take a look at what the chart looks like. But yes, I put a recommendation out on Wells Fargo just the other day in my service. And the reason that I like Wells Fargo is because if we're going to turn around, the financials are going to turn around, then I think Wells is got a bit of a floor underneath it. It doesn't mean it can't go lower. We would actually look, if we get down below a certain point, I would actually have my subscribers buy more Wells Fargo, because again, it's a long-term hold. Long-term for me is 5 years. It's really wink, wink, 3 years. But when I say long-term, I want people to have an understanding that if you can buy something and you're not going to worry about it for 5 years, I'm going to guarantee you're going to make money on it. I know that sounds ridiculous, but really, because we're buying companies that aren't going away. Wells Fargo is not going away. It's too big to fail. So it's one of those companies you can say, just like Microsoft or Apple or Facebook. I don't care what happens with legislation-wise. I don't care about Amazon, and I don't care about antitrust. It's not going away. The worst that can happen to Amazon is it gets broken up. Okay, if it gets broken up, then the pieces will be worth more than the whole. So I'm not worried about that. Those are long-term holds. And if Amazon is broken up, if we get a Democrat administration and Congress, there'll be a good chance of that happening, I believe, and we'll see tech under attack if we get that. And some of these stocks, we're just going to just really basically shake that off and move right along. So I don't have any worries about some of these companies continuing to go up, because that's just the way they are. That's the history of how the market operates for companies like these big giants, and Wells Fargo is certainly in that camp. Some of the other stocks, Peter, to answer again, continue on the Wells Fargo theme, and for everyone out there thinking and wondering about the financials, they have farther to drop. And I would rather add to a position that goes a little bit lower and it has a pretty good support, a level I'm pretty comfortable with. And if it breaks that support, yeah, then I would buy some more, because it doesn't have it's not going to go a lot lower. Some of these other banks that I think they've got some perhaps sizable moves to make to the downside, and I would rather wait on those. And the real big deal about Wells Fargo is its dividend yield at greater than 7%. Nobody else comes close to that, and I think the payout ratio is less than 70% on the Wells Fargo dividend. So all in all, plenty of room for that dividend, no reason to cut. I don't think the Federal Reserve is going to mandate the banks cut their dividends, because don't forget, the banks have already cut back their buybacks. All right, billions and billions and tens of billions of dollars in buybacks have been put on hold for the most part. So they don't need to additionally cut their dividends, because there's enough savings for them in terms of balance sheet savings by not buying back their shares. So I'm not worried about the dividend in Wells Fargo or any of the other financials for that matter, barring a horrendous third quarter. barring a horrendous sell-off in the market that knocks the equity of the banks down. That would change my thinking very quickly. So a couple more questions, and then we'll take a look at some of the main stuff I want to talk about today, and then we'll go to the graphs. Hi, happy to see you. Ursula, I hope I'm pronouncing it correctly. That's a pretty name. Ruby, please share. Okay, of course, happy to. Financials moving sideways, consolidation. Peter, again, yes. We hope it's consolidation. If it's consolidation, it's healthy. If they start to slip, then it may be indicative of less optimism on the economy coming out of this, the way the market is pricing a turnaround. So we'll look at those when we look at the financials. T-Mobile with SoftBank dumping billions. Yes, Peter, T-Mobile. Wow. SoftBank has it's a necessity for SoftBank to raise money. I will have a lot to say about SoftBank. I'll say it briefly. Greedy, overzealous, and predicated on a model that wasn't sustainable. And the SoftBank model, other than some of the companies that it's bankrolled that have been good investments, it got greedy and started to push with its big fund. Why? Because the fund was so respected, because of the size and some of the earlier investments that SoftBank had made. People thought SoftBank was invincible, and as a tech leader, it was going to be the company to follow. Where it was putting its money was where the companies were going to be minted, where the money was going to be minted. And WeWorks is the perfect example. Absolutely greedy, waited far too long to go public, can't go public. Now the company is an absolute mess. Several other companies, same thing, waited too long, got too greedy. And the problem I have with SoftBank is it was essentially putting in money very late in the game in order to increase the valuation of its portfolio companies right before it expected to take them public. That's a dirty game. And guess what? They got caught, and they're paying the price. So yeah, have to sell $21 billion of their T-Mobile shares. Serves them right. That's what you get when you're greedy, ladies and gentlemen. Okay, I'm going to write a couple of these stocks down so we can get to them. So if you guys have some, just send them to me. We'll take a look. Ruby wants to ask about Robo. Humera wants to ask about, I think that's, you want to look about some of the housing stocks, and that's a good one. Chester, any insight on oil sector? And then with Oxy, we'll take a look at Oxy, Len. Yeah, I got a lot of insight on oil, and we'll talk about that, Chester, when we pull up some of those. Obviously, oil has done well. We've seen a nice bounce, and if those of you who have been with me for a while since we've been doing the live stream, you know that I own oil. You know that I like oil. You know that the bounce that we all saw off of the ridiculous April move, when the futures went negative and oil went negative, was just insane. And we talked about that was probably a really good opportunity to get in, and it's proven to be correct. I still think oil has some more to go on the upside. Some of the companies still have tremendous cash flow problems, tremendous debt service problems. Most of them are going to be okay because the Federal Reserve is there with one giant cushion or mattress, and if they fall, they're going to get caught and they're going to bounce. But at some point, there's going to be a price to pay. So we'll take a look at Oxy and a couple of others, Chester. I'm going to grab through a couple more of these, and I'm going to go just chat up what's moving the markets today and talk about what may be a negative, and then we'll go to the charts. What are the chances of a huge skid? Okay, we'll talk about that in a minute. That's a great, and that is an absolutely pertinent and always pertinent question Ursula is asking. So I'll get to that in a minute. Carrie wants to ask about, okay, BIIB, got it. And Ursula says, we need minted money. Where to find it? You're not going to have to go too far because they're helicoptering it in, and they're going to have to helicopter more because we're not done here. That's part of what I'm going to chat you all up about. So yes, uh, uh, you're holding QLD, John. Is that it? I'm holding QLD. I'll take a look at QLD and a couple more ETFs. Talk about ETFs right now. And Peter, okay, we're back up to Peter on the questions. All right, real quick. So what I'm going to talk about is what, at this time of day, you want to understand, we need to know and understand what's moving markets right now. What's moving markets this morning? What happened with the futures? Why we opened the way we did? Why are we trading right now? What's likely to happen the rest of the day? And how that sets up for the rest of the week and in the near future. We can't see that far out, but we can certainly see in the near future based on what we're looking at right now. So where are we right now? Well, we're up. We're up big because as I started off, we have had some positive economic numbers. The market is looking for positive economic numbers. The market has created for itself a V-shaped recovery off of its dramatic sell down, off of its lows. A dramatic V, okay? Absolutely staggering, perhaps unprecedented. I don't recall this kind of action off of a low going into a recession ever before. So that's dramatic. But the market is doing this because investors expect that what's happened with the coronavirus, with the shutdown, with everything that's bad is going to get reversed fairly quickly because it came out of left field. If it gets cleaned up, it'll get booted out of right. And that's it. We're over with it and we'll move on with life as we used to know it. Well, that may not be the case, but that's the way the market's looking at it. And it's also looking at it as even if we don't get rid of the virus, even if we don't have a treatment, if we figure out how to live with the virus, because we're going to have to, then we're going to get back to business. People are going to come out of their houses. People are going to start spending again, and we're going to get back to life as we once knew it. Again, that's an unknown. Right now, we're seeing increasing hotspots in several states. We're seeing increasing hotspots around the world. So not good. But I don't believe the United States is going to stop lockdown again. Governors, it's going to come down to, I believe that if certain governors feel it's necessary, I've got a feeling the governors are going to fight with the president because President Trump does not want to lock down anymore because he knows the economic damage that has done. And coming into an election, he cannot afford to have the economy as devastated as it is right now, continue that way up through November. He expects to see it bounce. He expects the people to come out of lockdown, go back to living their lives, and the economy and the country getting back to where it was, which was in a beautiful uptrend. So to use the president's word. But we don't know whether that's going to happen or not. So right now, the market's continuing to believe that it knows the right thing. And then we get something like the new home sales today up 16%, and that's a positive. The market hangs its hat on that. The fact that we're going to go back and continue phase one with China, because Navarro had to walk back his statement that pretty much the deal looked like, in his words, it might be dead. But no, it's not. It's not dead because the president doesn't want it to die because he can't afford to, because that means that the farmers in the Midwest, the huge base for him, even though they've gotten tremendous support, tremendous stimulus in the Farm Belt, he's going to continue to do that. But he can't obviously push hard on the Chinese and walk away from the deal. By the way, the Chinese haven't walked away from the deal, but they might as well have. FYI, phase one of the deal that was signed in January requires the Chinese in 2020, from the signing of the agreement, starting as soon as they signed it, there was no timetable, but the Chinese were required under the phase one agreement to buy, let me get the exact number, $36.5 billion in agricultural products from the U.S. In the first 4 months of the year, they've bought $4.65 billion. According to USDA estimates, by the end of the first 9 months of this year, they would probably only have been able to buy, or will only buy, 8 billion. This is out of 36.5 billion. So are they going to then buy the rest of that in the last quarter? No, they're not. So the deal is pretty much done as far as the Chinese are concerned. They basically said, we're not going to do it. But by the way, the Chinese have been buying agriculture products. A lot of the agricultural products that they were supposed to buy from the United States, they have been buying from Brazil. Why? Because Brazil's currency has been hammered, making ag products in Brazil a heck of a lot cheaper than U.S. products. So Chinese have been buying, but they've been buying from Brazil. President can't really bring that up because that doesn't look good for the deal. So markets are looking at all that, and they're reading all this through, and like, well, so that's not going to happen. He's going to keep the deal alive. Another positive, we're only between 7.5 and say 11 points away from percentage points. So percent way from new highs in the Dow, new highs in the S&P. Wow, we're almost there. So the market's optimistic about that. So again, the metrics, every metric that comes out has been better than previous metrics. Why? Because the worst of the shutdown is over, right? We're past the depth of the shutdown when the whole country was shut down, essentially. So, of course, the numbers are starting to look better. The market just pats itself in the back and says, we were right. It's going to continue to go higher. What's the problem right now? Right now, the biggest problem the market's facing, and this is indicative a little bit of what we saw in the futures selling off. This is a bit indicative of what we saw on Friday when the Dow reversed and ended up down on the day, and all the other major benchmarks did the same thing, which was unusual for a change going into a weekend where we saw selling on heavy volume. That tells me that investors are starting to get a little bit nervous about this rally being a little bit long in the tooth. It doesn't mean it doesn't have more to go. It just means investors have a lot of profits on the table. It also means, and everybody knows this, everyone who thinks about it, and most people are talking about it, at least in the circles of professionals, retail trading, retail investors have brought the market up. They have been the ammunition bringing the market up, firing left, right, and center, good stocks and also speculative stocks, but basically bringing the market up. Institutions have had to follow retail investors. There's still a ton of institutional money that missed this rally completely. Some of them caught up later, but they still have so much cash on the side. There is the potential for institutions now to move the market higher if retail continues to buy. The question is, are they a little exhausted? Are they getting a little nervous, having put so much money down over such a short period of time? Are they looking at their profits and wondering, should they take them? Are they looking at the market thinking we can certainly go a lot higher, or we can certainly turn around because we haven't had any pullback, any meaningful profit taking other than on Thursday, June 11th. That was the only day we saw some profit taking. And there wasn't a lot of panic selling going on. The volume was heavier that day than it had been, but it was certainly no panic selling, just steady sell-off. So the question for everyone is, will retail continue to support the market? If they do, then we have earnings coming. If retail can continue to move this market higher, up into and through maybe the first week of retail reports, of earnings reports, say we'll call that the end of the first week in July, they will start coming out. If retail can hold the market up here and those earnings reports come out, we know the numbers are going to be bad, but investors are going to say that may be the worst of it. And there may be some buying there. So if retail can hold the market up right here, and earnings reports we know are going to be bad. A lot of what's going to happen on the heels of the earnings reports is going to be what kind of forward guidance, if any, are we going to see in here. The retail problem is if retail buying is exhausted and the markets go sideways over the next 2+ weeks and just look weak, even if they just go sideways, institutions won't come in and bid the market higher. They won't be the cause for another leg. They're going to wait for earnings and to see what happens with earnings. And in fact, and in that lull, if retail doesn't step up, there are traders who are looking at this market, having come so far so fast, who are dying to try and knock it down because they're expecting pockets of just no bid areas, and they can make a lot of money pushing a lot of these stocks that have come up very quickly to some of them, a lot of them new highs, and some of the ones that aren't new highs, the more speculative stocks, they get bet up. It's very easy to knock them down and scare those retail investors out who are chasing those up too. And if they change, if their psychology changes and they start to take their profits and start to pull back, then yes, then we can get a down leg, right? That hasn't happened. So far, it hasn't happened, but I've seen tiny little signs of that potentially happening. So that's what I'm keying on right now. We're going to keep an eye on the volume. If the volume starts to fall off as we go higher, that's less conviction, that's less retail coming in, then we might get a little thin. So that's what I think we need to keep an eye on. We'll talk more about that on Thursday. There's something else that's coming. It's a little bit past the earnings season. Just on the heels of that, there's something else that's out there that if it doesn't get fixed, that's going to pressure the market. We'll talk about that on Thursday. Okay, let's have a quick look at some stocks and the companies you guys want to take a look at. So I'm going to do a little screen share here. I hope I've tried to just re-up my internet here and tried a few things. So hopefully the service is working better and you guys are hearing me loud and clear and we're not having any interruptions. It seems to be working well, so let me know. But let's do the screen share. And I'm going to go to bar charts. And here's Wells Fargo is the first stock I have up because this is one that we were talking about. This is a stock that I recommended in Money Map report. And again, the reason is I think that Wells Fargo, besides having a splendid dividend, if it fails, if it turns over and it doesn't look like it's going to zoom higher, does it? It looks like it's muddling along the bottom. And if it muddles along here and it comes down a little lower, then fine. I'm worried about the other financials doing a turnaround and having to sit on some losses there without having the same kind of dividend yield return and watch those stocks go down. Here, the timing of the buy recommendation on Wells Fargo by me is this is where we're at. Okay, is that healthy? No. We are just above the 50-day. We are below this thin black line is the 20-day moving average. The blue line here is the stock's 50-day moving average, and the red is the 200-day moving average. So here's what the stock looks like to me. It's going sideways. Yes, it broke down here again. Every other stock, certainly every financial, is going to show this pattern going into the bottom of the March sell-off. Now, like every other stock, pretty much every stock, we had a nice bounce. Wells Fargo had a nice bounce. Got up here, and we're going to see this in the other financials, the other banks. So we had this sort of problem area where we couldn't get through anywhere. We couldn't rise higher, and that's because we've got the second quarter coming up. Everybody wants to know how much more the banks are going to have to provision for loan losses. That's a big deal. This is what's kept the financials from moving higher, from breaking out, because things are going to get worse for the financials, for the banks, than they are for other areas. Why? Because of the amount of bankruptcies. Just because the Federal Reserve is supporting corporates, supporting corporates in the primary and secondary market, supporting them in ways that are just insane, in my opinion, doesn't mean that these companies are going to not still have defaults, not still have tremendous issues, and not still have to report those, because they are going to. So this is what the banks are looking at. What are they going to have to reveal in the second quarter as far as their loan loss provisions. Let's assume all the trading banks are going to do well. I believe they should do very well. It wouldn't surprise me if some of the banks had near record trading profits, because their banks are traders at bank shops are, generally speaking, excellent and very aggressive, and they do very well in a one-way market. We've had a one-way market off of the lows. They should do very well. So here we are. And to me, we could get down to, say, 25 range. The stock is at 27.64 right now. You see that up here. And so, it doesn't bother me if we get down to 25. It bothers me if we get down to 21.75, get to 22. Yeah, that would bother me. But frankly, I put out a recommendation to buy more. This is a long-term hold. And you're buying down there, you're getting even a fatter dividend yield. So that's why I like Wells Fargo. So let's take a look at some of the other stocks you guys want to take a look at. And again, we'll take a quick look at the rest of the banks. Just a real flash run through of the rest of the banks. We're going to start with Bank of America. And this is just to speak to the similarities that sectors have, stocks, companies within sectors have. And it's sort of like, in a sense, tracking the Dow, the S&P, and to some degree, sometimes the NASDAQ. Only the NASDAQ has left the Dow and the S&P behind. But people ask, why do I quote the Dow and the S&P? Shouldn't I just be quoting the S&P in terms of the benchmark of the market? No, I like the Dow because a lot of folks follow the Dow. A lot of newscasts only announce what the Dow Jones Industrial Average is doing. They don't talk about the S&P. So we talked about all three of them. But if you look at, and they kind of track each other to sometimes a large degree, sometimes a lesser degree. But the financials pretty much track each other too, for the most part, in a similar fashion. So here we have the same kind of action here, same thing, the big drop, the bounce. Here we had better action here because we made this really nice high up to the 200-day moving average, stalled out here in Bank of America. What's scary about the financials is this big drop down, this big just roll over, play dead. Now, here's our just short-term support right here. If we break down through here, we're below the 20-day here. We're nicely above the 50-day, but we're below the 20, and we're heading back down to the 50. If we get down to the 50 on Bank of America, that means we'll have broken through this uptrend. And will Bank of America have rolled over? Remains to be seen. Right now, it's still holding on to that uptrend. But this is what worries me a little bit about the financials. This is what worries me a little bit about the economy. It's sort of the expectations in reality, not speculators, not investors wildly hoping, and sometimes that's what it is. The real money that understands how to play the banks and watch the banks, they're doing the wait and see, like with the banks. So there's a quick look at, we'll take a look at Citi. I see a similar picture in Citi. Citi's more international, a lot of overseas locations, and that does very big international business. We have similar pattern there, still intact, but again, trading down really just slightly below its 20-day. Yesterday was below its 20-day. Today it's kind of right on it. But again, when you see a fall like this, that's a little scary for a bank. So we've seen this kind of action, and certainly we've gone higher. But again, we're not out of the woods with the financials. So we could be in the consolidation phase. And if Q2 numbers in terms coming out of the banks are good, and they don't have to provision so many loans, and some of them may say, things are better than we thought, then the banks would be in. Right now, we can look at that as what they're doing is hopefully consolidating and moving higher. So that's, again, remains to be seen. We don't know. This is a lot of times you can analyze things and have a clear understanding, at least clear enough. This time, it's very difficult to have any kind of clarity, simply because we haven't been here before. And what we're trying to do is calculate things that we don't even have enough data points for. So it's just, you can't do it. Anybody says they can, I'm just going to be honest and tell you, hey, it's a good guess. It's my best guess because that's all we've got right now. That's all anybody has. And you know that when you hear so many different people with so many different opinions. So that's the banks. And last but not least, we'll take a look at JP Morgan real quick, the biggest US bank. And pattern there, all the banks are up today, so they're doing pretty well today. But still, there's nothing to be proud of here. There's nothing to be sanguine about here. Trading below, and more so than the other stocks, below its 20-day, coming down closer to its 50-day. And so, yeah, would you jump in right here? Not really. We did in Wells, again, because of the dividend, because if Wells has further to go on the downside with the rest of the financials, it may not have as far to go. So in other words, there's been more trading in the rest of the banks. There's been more assuming positions and hoping the banks are going to go higher. Not so much with Wells. So these can fall further if there is a turn down. So that's my shot with you folks on the financials. Real quick, let's take a look at Boeing and Disney, because I'd like everyone to be thinking about Boeing and Disney, because these companies are at some point in time, and it may be now, just a sterling sterling opportunity to own these two companies. I think both of them are going to take a while to come back, but these are getting at the right time, and don't look at them again for 5 years. You'll double your money. The question is, you want to try and be comfortable sleeping at night knowing that you got in at a low enough level. You don't want to be getting in at a level, then watch the stock go down 15, 20%. It's nerve wracking. Even though you're holding for 5 years, it may be just fine. I like to get stuff on the cheap. So I'm looking at Boeing, I'm looking at Disney. For myself and for a lot of folks who've been asking me, this is what they look like. So you got this nice, it's off the bottom, gentle slope up here, which Boeing is trying to recover. None of the news out of Boeing is good. Okay, leave it at that. So there's, we're very headline driven. There's no good news out of Boeing. I don't care how you want to color some of the things that some people consider, oh, that's a good announcement out of Boeing. No, nothing. There has been nothing good out of Boeing. So this is the stock right here. We got this little triangle, and technically sometimes you get a movement out of a triangle like that, and it could go either way. If it goes up, then great. If it goes down, then we're just going to start to look and see how low we can go. If we can go lower and we can get through the 50-day, I'm going to start looking for that kind of action to find an entry level at Boeing. I've told you guys I am kicking myself because I got greedy and I didn't buy Boeing at 100. And I actually had a buy order in, and I pulled it because I did the same thing on the way down. I did that at 240. I said, no way. If it hits 240, it's coming down lower. I did it at 200. I pulled it at 200. Then I waited and I said, this thing's got a lot lower to go. And I was glad that I pulled my bids. At 150, I thought, okay, maybe this is a good time to start looking at it. I said, no, I don't think we're done. At 100, I said, I don't care if we're done. I'm buying it at 100. It got to 100. And I said, you know what? This could go lower. I pulled my bid. Now that's greedy and stupid. Okay. So just be aware of that. If you see something at some level, be happy to buy it there. Okay, my bad. I should have bought. I didn't need to buy a big position in Boeing at 100. But if I committed, say, 20% of the capital I eventually want to put into Boeing, I would have been really happy right now. And frankly, if I had done that and watched it go up, I probably, in this move around here, I probably look to buy more somewhere in here. So, okay, I already got it lower. I would add here. And I would have been pretty happy. But I think we may get another chance. So we're not out of the woods with Boeing. I do want to own Boeing. I think in the long run, it's going to be a great company to hold. Why? It's a duopoly. Boeing and Airbus, that's it. And Airbus is just as much trouble as Boeing. But I want to buy this, and I think you guys want to take a look at it too. Disney, same way for me. I think Disney may have a little bit of a harder time climbing out of the coronavirus crisis if we get repeat hotspots, if we get a second wave, if the coronavirus is going to end up looking like the influenza and come around every year in a different form, then and we get shutdowns, people aren't going to want to go to the theme parks, people aren't going to want to go to the movies. So yes, Disney has streaming, Disney has a lot of stuff going on, but the theme parks are also a big part of Disney. So here's the stock. I didn't buy it off the bottom because I was really unsure of entertainment business, and I really wasn't even thinking about it. I was just going to wait for it to somehow settle. I thought it would settle down around the 90 to 100 level, give a chance for the stock to consolidate and give me a chance to figure out whether it was going to break that lower or start to go higher. I didn't get that opportunity because we know what happened. Here's the bounce. And a lot of that is retail, okay? Institutional investors aren't jumping into Disney. It's retail investors, and being smart, they bid it up. So here we are right now, right? Clearly under the 20-day moving average. This stock looks to me like it's rolling over, right? Here is the 50-day. You can see it's just under this green uptrend. Channel marker. Now we're coming down here. The stock is up a little bit today. We're at 116.73. Now, if we get down here today or tomorrow, we get down to the 113 range, and we get below that, and we get to 113. We're down below this uptrending channel, and right now the 50-day is at 112. It looks like probably not 100% accurate, within some pennies. We'll just call 112. Okay, so the stock can easily get to 112. When we get to 112, we're touching the 50-day. A lot of folks who were thinking about it are not going to buy it. A lot of folks who owned it might think, well, maybe I should just take whatever profit, especially if you bought it on the dip down here. You're thinking, well, while I still have a profit, and by the way, if I take my profit and it goes down, I can still buy it lower later. All right, that's the thinking, and that's what the thinking should be. If you own it and you don't mind putting it away, then don't worry about it. Me, I am looking for Disney to break down. I am looking for Disney. I believe Disney's going to come right down here and test 100. And I think part of the reason it's going to do that is when the Q2 numbers come out on Disney, I think they're not going to be able to provide any kind of positive forward guidance, especially if there's any more lockdowns. And right now, by the way, Disney employees in the theme parks don't want to come back to work. Okay, that's a problem. So I think Disney is going to come down. As we're only a couple of weeks away from getting earnings reports in for Q2. I think when we get Disney's, I think there's going to be a shakeout prior to that. I think earnings are going to bring, we're going to see some profit taken possibly on earnings. And again, that's based on maybe retail not holding the fort until earnings start to come, and then the market drifting lower. Earnings come out, and instead of retail buying them, they may just sit on their hands, and then you're going to get some hard institutional players betting against the market can drive it down. So that's what we're looking at going into the earnings season. So yeah, I'm looking for Disney. Would I buy Disney at 100? It depends what the rest of the market is doing. I'm looking to probably take my first position of Disney at around 100. I will swallow hard if it gets back down to 90, but I'll certainly be buying more. And I won't like it, but frankly, if it goes down to 80 again, I don't care. I'm going to buy more. So at this point, I'm going to just average down into Disney, and I'm going to put it away for 5 years and not worry about it. And I really believe I'll double my money on Disney. So that's Disney. Now, you guys had some other ones. Let's bang them out real quick. Got a couple more questions, and we'll call it a day. As we speak, the market is doing a whole lot of nothing. It's holding up very nicely. NASDAQ, of course, leading the charge, up almost 1.4%. So we asked about, I think, Humera was asking about, I believe, Lennar. And great question, because talking about housing is obviously appropriate. We're talking today about new home sales being up 16.6%. May existing home sales were down 9.7%. Part of the problem with the existing home sales is that they're old. The homes are old. It's a lot nicer to buy a new home. It's also easier to do changes on new homes if you get them right away, because sometimes the builder will work with you. But also new homes right now, people are apprehensive about moving into an old home. I'm talking about coronavirus. Yes, I'm talking about things like that. So people are looking, I just want to move into somewhere brand new where no one has lived. And I know it's clean, and I know it's this, and I know it's that, and it doesn't have any problems. Of course they do, but so new home sales are probably a little bit more important. I'm not so worried about the existing home sales being down 9. I think it's a positive that the new home sales were up 16.6. That's a good positive. By the way, new home sales as a percentage of all home sales, only 10%. So existing home sales market is much, much, much larger. So the builders, how are they doing? Well, this is positive. This is really a great stock chart. Is Lennar consolidating in here? Yeah, it certainly looks like it's consolidating, but the pattern is up. If you own it, I think you're, well, I know you're happy, especially if anybody bought this down here. This was a great play, and you still got some upside here. So are we through any of the support yet? No. We're right on it. That's great. So if this stock can go sideways as far as I'm concerned, and it's nicely above its 200-day. So to me, that's a strong. I wouldn't worry about this stock unless it maybe comes down to its 200. And then some investors and technical traders will look at that and say, oh, if it gets down below its 200, and the 200, by the way, is really still above the 50, and then people aren't going to be real happy about that. There may be some profit taking there, but that hasn't happened. And right now, so far, so good. And the stock is down a little bit today, but I think if anything, the stock is hopefully just consolidating in here, and hopefully has a ways to go higher. If you're worried about getting out, if you have a profit in this, and this is what I'd like everyone to think about, is like, I'm nervous about the market. I've made some money. How do I hold on to it? Take profits. There you go. There's some support. I see right around here, we got some support. Okay. So this line here, and we'll call that 57 and a quarter, 57. So that's not, the stock's at around 61 now. Me, if I owned this stock a lot lower and I have a nice profit in it, and I'm apprehensive about the market, and I'm apprehensive about the stock performance here of Lennar, I might take my profit at 57 or so and just say, if it comes down lower, I'll get back in. But I want to ring the register, because if it drops lower and you're holding it and you're watching your profits evaporate, that's nerve-wracking, and you never know what to do. I like to sit on a profit and then reassess the stock. So that's how I look at Lennar. But housing has been strong. The housing market is good. I know the places that I've been to and folks I talk to, the housing market's a lot stronger. It's held up really well. Doesn't mean it will continue to. We're going to talk about mortgages on Thursday. We're going to talk about some strange trends there and some things that are a little bit worrisome. But right now, we're holding up. And as far as new homes, as far as the home builders, they look okay. They don't look to me like they're rolling over. They look like they're just taking a breather and hopefully consolidating. Hopefully that helps you with Lennar. And now, got asked about Global Robotics and Automation, symbol ROBO. I can't say I know this company. I will say that that's a pretty exciting move off the bottom for sure. Absolutely parabolic. The stock prior had been working its way up. Okay, we got the coronavirus crisis and sell-off. That's not unexpected. We know that. But this ascent back up to new highs is really positive. So here's the interesting thing. We talk about this here quite a bit. We got a gap here. And that's a pretty dramatic gap from 44 44.32 down to 43.34. It's not big in terms of percent or dollars, but it's a pretty healthy gap. And now we see the stock trying to bounce back from that. And we're just above, let's see, at 40, we're at 43.78. We are above the 20-day. This stock looks like it wants to fill this gap. I see we got a little gap here. I don't know if that means much, but stock looks like it wants to fill this gap and try and hang around here and maybe go higher. So if you own it, congratulations. It's done really well. If you're thinking about should you bail anywhere, I don't know. For me, I like to hold on to profits. If this stock gets down somewhere down here, 41, then I'm kind of wondering how it has fallen so far when it looks like it looked so healthy. I might think about taking profits if I have there. But we've got the 50-day above the 200, the 20 days here, 50 days rising nicely. I would hold on to the stock and again, only consider taking my profits if it comes down to me. I don't know, it started like 42. I started to get a little bit like, well, why is it down here? If I have some profits, maybe I just want to take them and see where it goes. If it goes lower and I love the company, I would buy lower. But again, anything can happen in this market. But so far, that's a winner. Let's have a quick look. See if it's broken anything substantial. And I'm going to draw it off of the old. So we're right there. Did we come down through it? Yes, we're still trying to get above it. We're right on it right now. I would draw that line and try and see you'd be comfortable with the stock above that trend line. You're good. Below it, at this point, below it, 43 is not really much to worry about. 42, I don't know if we were. I think it could hold 42. I don't know if it gets to 41. To me, I'm a little bit nervous, but doesn't look like it may do that. So, good luck with it. I think Robo is a good looking stock. Let's talk a little about the oils. We've had a tremendous run in crude, in WTI and Brent. Really nice move, and this is what Occidental Petroleum looks like. The problem with all of the oil companies, there's no guarantee that the price of oil is going to continue to go higher. I think we're in a good place. I think we can get to 45 on WTI, and I think we can consolidate between 45 and maybe 38. In which case that would be fairly strong if the global economy starts healing and oil stays in there. Then it's got certainly another leg higher. Problem is that the case for oil? Well, we'll see. Remains to be seen. That's my bet. That doesn't mean that the oil companies are all going to move, because oil isn't going to just scream higher until the global economies start actually moving higher, starting to see growth, and we start to see more oil demand, energy demand. So the problem with an Oxy, all of these companies are speculative right now, all of them. Okay? There is no guarantee that just because these companies are great and strong or whatever you think they are, that stocks can't go down, because none of them are that strong. Because if oil turns around, none of them are that strong. I don't care what their balance sheet looks like. And by the way, none of their balance sheets look good. So I view all of these as speculative plays right now. They're good speculative plays, by the way. If you like oil and you think that these companies are worth the buy, there's going to be a lot of money to be made. Okay, so can Oxy bounce off here? So far, it looks really good. Do you want to play the stock from the upside? Yes, I certainly wouldn't play from the downside. It's got a heck of a lot more room on the upside. And so, yeah, I would, any of these companies, the pipelines, the explorers, producers, any of them are good speculative plays. Just be careful that you don't let losses get the better of you. To me, these are trading stocks right now. If you they end up being an investment because you traded it properly. And by that, I mean, I look at every position I put on as a trade. I want to manage it as a trade. If it goes my way, then by the way, that includes if it goes lower and I average down, I'm still trading it. At some point, I may not want to hold it anymore and I may dump the whole position. But if it's something like a Disney or a Boeing that I think is going to be a grand slam over time, or a Wells Fargo, then I'm going to act like a trader and try and accumulate a position at the most favorable price and put it away. So every position, new position, is a trade. If it becomes an investment, it's because I traded it properly. I ended up, buying it where I needed to buy it, and then I start to watch it go up. At that point, it's an investment. And if it's a long-term hold and it continues to do what I expect it to do, that's how it turns into an investment. A stock like this, like Oxy, or any one of the oil companies, if you get your timing right, this will turn into an investment. Okay. But right now, there's no guarantee that these are going to be great investments. They may prove to be. I wouldn't wager the farm on them. That being said, you buy something like this down here in the 21 range, and if your timing is good and we start to see global growth, we start to see the oil companies firm up and move higher, then you got a winner. You're looking to me, in 2 years, 3 years, you're looking at a double in your money. And I always go for at least a double. When I'm buying to accumulate a position, I'm looking for a double. I want to make 100% on my money in 2 to 5 years. You do that regularly with your positions, you're going to find yourself very comfortable. And really, that's how I trade. I trade to hope to turn my trades into investments. I still trade short term and take profits, but when I'm trading a stock that I think has long-term potential, that's how I look at it. And it might be something for you folks to consider too. We've got a couple more real quick, and I think we got another bank to look at. But I don't know if we're done with the banks yet. But Biogen, again, timely look at these companies. It's just all over the place, and just because it's up today, I don't like the way this stock has traded. You got this huge gap here. I don't know really why you had that. Obviously there's some expectation that something's going to happen. Maybe there's going to be a bid, or a product or a drug that they have has done something. You got this nice move here. This kind of action is crazy. This is just total speculative stuff to me. It's like, yes, I get that what they do in the field they're in, you can see this, but then here it is, a lot of nothing. Again, these are volatile days. This stock, trades in a range. Look at these moves. Every one of these bars is a considerable move. Up again, all over the place, down, now broken down. So do I like this here? No, I would. This stock has too much action for me to consider to want to hold. Certainly, would I trade it? Yeah, I would trade it. I would probably just try and swing trade it. But I don't think you folks are doing that. And a lot of you shouldn't be doing that, because that means you should be watching. You have to watch the market, and you have the time to watch the market. I don't know that you want to do that. That's hard work. So here's this gap. We'll just kind of take this right over here and see where we go with this, because I don't like where this is going. You come right back up. There's that gap there. If this stock breaks down here, it could go right down to 241. And really, it's I don't know. It's not my cup of tea. Obviously, below everything, it's trading below the 50, 200, 20, not even close. So be very careful on this one. Is this the kind of catch a knife, buy it down here, hope it goes up? This kind of stock, you could slice a finger off. So be careful if you're trying to catch a falling knife here. On the upside, that's a tough ride. So be careful. QLD. I've taken up a little more than an hour of your time, so appreciate you guys sticking around with me. And oh no, you gave me QLD, I believe. So here's look at the Qs. Okay, while we're here, um, the Qs are really the place to be if you want to. I mean, I'm not. You guys know what I feel about the ultras, the leveraged, and QLD is leverage. And I say this time and time and again. I'll continue to say it every time it comes up. If you get a multiple day run in something like QLD, in anything that's leveraged, whether it's 2x leveraged or 3x leveraged or whatever it is, start to think about, first of all, be happy and start to think about where you're going to take your profits, because it's a great trading opportunity. So you've got a tremendous move. You've got really a couple of days here. Can we see further gains tomorrow? Should you hold this overnight? I would, because the way the market's acting, I would probably try and squeeze another day out of it. And if the market was roaring tomorrow, I might take my profits. But we're looking at, making new highs. So at this point, I don't really want to sell it. It's a leveraged ETF. It's on the QQQs. All right. So it's on the NASDAQ, representative of the NASDAQ 100. That's the best index to be in. Okay. So as far as that goes, this is the right pick. As far as a leverage play, this is the right pick. As far as greed, enjoy it. These things don't last forever, because you look at this tremendous run here. So if you gotten in, say, anywhere down here, and let's say you're lucky enough to just take a shot here because you like the market here, and you had all of this run, you got a tremendous amount of profit there. To me, take it. So what about the next day? Look how much you give back so quickly on a leveraged ETF. And by the way they're priced, you gave up a heck of a lot more than you probably thought you were going to have to give up in profit. So now, for those of you who maybe got in here and have ridden this up, okay, don't be greedy. Maybe if you are convinced that we have more to go, and I'm not saying we don't, because the market certainly is acting that way, then at least take off half of your position. So again, leveraged ETFs, great trading instruments. If you get a few day run, you get a multi-day run in your direction, absolutely fabulous, great trading instruments. Don't play them for the long term. You'll get killed. All right. I think that's it for the stocks we wanted to talk about. And hopefully that covered most of what you guys were asking about. Let's go back and see if there's any questions before I bid you adieu. So again, healthy market hasn't really done much since we've been talking. Dow's up 0.84%. NASDAQ pretty much where it's been all along. We're kind of stuck here, which is good. What we don't want to see in the afternoon is selling off. We start to see increased activity around 2 o'clock. So, if you guys are watching the market on a regular basis, you always want to watch the open. Again, for the most part, a lot of retail activity at the open. The close is more institutional. But around 11, you see 10:30, 11, you see things slow down, and maybe there's some action over lunchtime, but some traders trying to move some stuff. And then around 2, you start to see some action there. So 2 is going to be interesting to see if the market, whether or not traders trying to push it down or push it higher. They can go either way. Right now, I'd be surprised if this market turns around. It just seems to be stuck right here, and that's not a bad thing. So far, so good. The week is setting up well. We'll talk again on Thursday about some of the things that bother me. That being said, the bother part, there's nothing wrong with being concerned. Nothing wrong with being cautious. There's nothing wrong with being protective of your money just because we've had a tremendous run. At the same time, I try not to fly in the face of the trend. I try and let the market tell me what it wants to do, what it's going to do. If you listen, it usually is pretty direct about telling you. And if you listen and you understand how to listen to what it's saying, you're going to make a lot of money. So I don't want to go against this market. There are some stocks I don't mind going against, but for good reasons. The market in general, I want to try and trade mostly on the long side, certainly the market, but also most of the stocks I trade, I want to trade from the long side because the trend has been up. Doesn't mean it can't change. So far, so good. A couple quick questions and we'll say our good evenings or good afternoons. John says BAC looks better than does Wells Fargo. Yes, it does. But again, I gave you my reasoning, John. If I want to buy something that if I think the banks are headed for a little bit lower, they're going to be under a little stress going into earnings reporting. I think Wells Fargo will fall less. And again, I want to buy Wells Fargo for its yield. I also want to buy it for its appreciation potential. And I want to buy it because it's close to its lows. So that's my reasoning there. Carolyn's asking, what's a good entry point for both Newton Plug? Wow, those are good questions. I'm going to give it to you for tomorrow. How about that? Excuse me, Thursday, Newton Plug. Yeah, I'll do a little homework on those for you. John's asking, I think John to be asking if I'm holding QLD. No, I'm not. So just want to keep up with you guys and some of the stuff that you want to know. For me, John, as far as QLD, if I want to play the trend and I want to play, I think, the leadership index, which to me is the NASDAQ 100, I would just buy the QQQs. And I wouldn't worry about trying to leverage that and worry about the daily volatility, because we know intraday sometimes and day to day was not so much intraday that matters, but day to day, we can see a sell off and then a rise and a sell off and a rise, sell off. And that's what kills the leveraged ETFs pricing wise. I would rather, if I'm going to play the uptrend in the market, play the triple Qs. I'd rather just buy QQQ and not worried about days where it maybe trades back down, because longer term, I'm going with the trend. I don't want to have to worry about how much I just give up on a down ugly day because the ETF got repriced at the end of the day and I'm getting beaten up on that. So for me, if I'm going to hold it a little bit longer because I think the trend is going to continue, I'd rather buy triple Qs than I would a QLD. That's me personally. If I was trading, which I'm not doing, trading, I used to be surrounded by screens and just all day long, I was immersed in it, I would trade QLD. Yes, I would, but I would day trade it. I would pretty much trade it for swings for a couple of days at a time. But now I'm not trading that way anymore. That's not what I'm doing. That's a game that I played for a long time, and it's exhausting and it's time consuming and it's all consuming because then you start getting into stuff you're holding overnight international and you're up at all hours because I'm trading internationally and currencies and that's just the way it works. You're coming up with all of these plays, and let's put it this way. I like my life the way it is now. It's a lot mellower, and I don't need to be consumed with data every second of the day. Okay, I think that's it for today. Hey, everybody, thank you so much for being with me. It's my pleasure, and I really like answering your questions or addressing some of the stocks and the stuff that you put out there. I'll look forward to seeing you on Thursday. Have a great day. Cheers, everyone. Be safe out there.